And if we see someone that shows us that, then that's when we'd be interested in understanding the other intangibles around them and the other factors about the strategy. So if someone's had a lot of success doing something for a number of years, and then we talk to them and we get comfortable with their explanation of why they were able to have that success beyond just the numbers, then we would be interested in then assessing, okay, do we believe that this person.
Welcome to Unstoppable Podcast with Harry Sardinas, inspiring conversations with influential millionaires, investors, thought leaders, entrepreneurs who are making a massive difference with their innovative products and services, and sharing the challenges and wisdom of how they sold their first million.
How much capital they need to deploy in order to be part of your organization?
So is quite approachable. It's 250,000 US dollars, and likely in the not so distant future, we're going to raise that quite aggressively, just given the demand we've seen from investors who have been allocating to us. But for the time being, it's at, like I said, 250,000 US dollars.
So that's the minimum that the investors can deploy in order to be part of the fund. Is that correct?
Yeah, that is correct.
Okay. And then they can choose which vehicle the funds will be allocated, or you guys do this for them and spread it equally across all the vehicles?
We do this for them, so we're one vehicle, and then we allocate the capital out to the portfolio managers. And the value of our product is not just any one of the managers we have, but because they're uncorrelated to each other by the way that we divide the capital across them, that's what allows us to be so consistent month to month and also have very low drawdowns versus almost all of our competitors.
So what is your background? Do you have background in finance? How you came out with this business?
So I went to Queen's University in Canada. As I was there, I started a derivatives trading club. And though that was useful, because as the leader of the club, I had to learn about advanced derivatives concepts to teach them to my fellow students. And we all know to be able to teach a topic, you have to understand it very well versus just understanding it to a surface level. But the most important thing was at the end of every year, we had a year-end conference, and I was in charge of sourcing our guest speakers. And I was fortunate enough to be able to get a number of the top portfolio managers and hedge fund managers in the world to agree to be guest speakers via Zoom to our club at our conference. But obviously, you can only learn so much from someone, no matter how knowledgeable they are, in an hour or 2 hours of their time. So I bugged all of them to take me under their wing and mentor me. That greatly sped up my learning curve. And to this day, I refer to them as my personal board of advisors. So being able to bounce questions and ideas off of true experts at very niche trading topics hugely sped up my learning curve and put me in a position to then start a biotech algorithmic trading strategy. When I was 21 years old, I raised a few $1 million as a proof of concept for that during a time where the biotech sector crashed the most in its history. My strategy held up very strongly and did well, so that showed real skill in selecting securities without just relying on the sector doing well, given that there's a big disparity in my favor between how my biotech holdings performed over this 4 year and 8 month period versus how the biotech sector as a whole did. And then what that taught me separately than that, though, is I wanted to build more of a real lasting, durable business. And I saw to do that, I would have to diversify. But I saw if I just traded biotech and then diversified most of the capital myself, I couldn't be an expert at the other things like I was in biotech. No one can be an expert at everything. So that would water down the quality of investing going on. So the only way that stood out to me where it would be possible for me to be as diversified as I wanted to be without watering down the quality of return being delivered was to find people who were experts like I was in biotech, but in completely different, unrelated small pockets of the market. And I was able to find a number of those people and then recruit them to contribute to the team.
So when are you bringing someone to your team, what you evaluate? Because is critical, and what you described, like the fund have to perform when the market goes up, but also when it goes down, and therefore the strategies of the different vehicles of there, either crypto or stocks or another vehicles, they had to be in line with that strategy. So, what are the factors that you evaluate before bringing a partner, a fund manager to your ecosystem with the new strategy?
So for the first thing we want to see is someone who's had a lot of success doing their strategy for multiple years. And if we see someone that shows us that, then that's when we'd be interested in understanding the other intangibles around them and the other factors about their strategy. So if someone's had a lot of success doing something for a number of years, and then we talk to them and we get comfortable with their explanation of why they were able to have that success beyond just the numbers, then we would be interested in then assessing, okay, do we believe that this person will stick to this strategy going forward? And are they good at managing risk versus did they get lucky and show that they had good risk management just because there were no stressful periods to what they were doing? If we see that they were actively managing risk effectively and in a disciplined fashion on top of having success in a repeatable way at a strategy that we believe could continue to have success going forward, then we would hire them, give them a small portion of our capital, and tell them just to continue doing exactly what they were doing in the exact same fashion. And then we would constantly be watching their performance. And as long as it's not deviating outside of its expected band of outcomes, then we would keep them on the platform. But if it did deviate outside of its expected band of outcomes to the downside and over a certain amount of capital was lost, then that's when we would offboard them from our platform and sell off their portfolio and then take that capital and spread it out across people on our team whose strategies are currently working and making money.
So 10 to 15% per year returns, right? And then the client can leave it there and it will compound. Is that correct?
Yes, that's correct.
Okay. What are the what message do you have uh, for investors out there that uh, that they are maybe looking at more traditional strategies in
I
order
would
to
just
grow
say
the
that,
capital?
yeah, I would just say that traditional strategies have a place in everyone's portfolio, but they shouldn't be the only thing. And the reason why is you could have a number of different traditional strategies and think that you're diversified, but at the end of the day, if you look at how almost any traditional strategy did in a true crisis event, whether it be a great financial crisis or COVID or the tech crash, that all of those traditional strategies and approaches pretty much all had a difficult time at all of those moments, no matter what traditional approaches you took. Whereas an allocation to a truly uncorrelated multi-manager hedge fund that's market neutral in moments like that can still put up a positive return and or protect your capital instead of drawing down alongside the other traditional parts of your portfolio. So we're not telling people that we should be the only thing in their portfolio, but we're telling them that they definitely should look at things like what we do as a way to diversify their portfolio and to allow them to sleep at night that there's at least one piece of their portfolio that is in a good position to be durable and robust and strong during market crisis events while still making a positive return during normal times.
Like, if someone is in love with this conversation, how people can find you, how this process works?
Yeah, so if someone liked what I had to say on this conversation and some of the other podcasts I've been on, then they can definitely reach out to me. There is an email on the Sixth Turn Capital website that's info@sixthturncapital.com. They can also find me on my LinkedIn, Zachary Leavitt, and send me a message there. And then from there, I'd be happy to set up a Zoom call or a phone call with them and go over the process of how they could be onboarded to become an investor in the fund.
Thank you so much. Zach, for this interview, and for all of you following the podcast. See you in our next episode of Honest for How Brave Entrepreneur like Zach and achieve first million. For now.
Thanks for having me.
Follow us for more interviews with world's most influential, audacious entrepreneurs that overcame challenges and adversity, providing you with the blueprint of how they sold their first million so you can grow your business exponentially.